All right, all you lovely Herle Burly-ites. You know, there's certain things in this world that I really love. The Habs, the Riders, Elton, rum and coke. And one of the things I really love is talking to Frances Donald. And by God, she's here. Frances Donald is with us again today. The Economist explainer-in-chief. The person who puts the fun in economic fundamentals. Now from her new perch as Senior Vice President and Chief Economist at the Royal Bank of Canada. All anybody can talk about is the economy these days. Prices are too high. How low will interest rates go? What are the prospects for our economy? How badly will Trump tariffs hurt us? These are the questions on people's minds, and Frances is the person to answer them. So, hey, welcome back.
Thanks for having me.
It's always a thrill. You're such a fun person to talk to. Guests love it, by the way. You're one of our favorite. You're backed by popular demand. Let me put it that way.
Well, this is a good place to talk about economics, David, because so much of what we do, especially publicly, is 2 to 4 minute clips or one-liners or blurbs or social media quick posts designed to get you to click through. There are not a lot of places where you actually can dive into the nuance, and most of the Canadian economic story is nuance and can't properly be captured in those other forums. So it is always a pleasure to be here, and I think it's the right kind of place to talk about these issues.
Awesome. Hey, how are you doing? Are you still in Montreal?
I am in Montreal. We are doing great. I spend a lot of my time during the week on the road all over the place, all over Canada, the US, and probably beyond. But Montreal is my home now and hopefully for a very long time in the future.
Right. So moving to the Royal Bank didn't affect that. That's great. Do you still get to live in Montreal?
Listen, I go where the business needs me, and the business needs me just about everywhere. So I'm pretty close to the airport around here, and I can get, as I say, anywhere in Canada pretty much by lunchtime. And I think that's what matters most.
You're at the Royal Bank. I hear they do well. Are they doing well?
That is indeed what those who follow banks might say. And it's a real pleasure and certainly an honor of a transition. I miss my colleagues and my role at Manulife, but this is an incredible opportunity to be able to see the network of clients and the power of an institution like this one is a change of experience. And the role is a little bit different too, David. I can tell you, even though it carries the chief economist title, it is a different flavor of chief economist.
In what way?
Well, I've always sort of believed, because there are the economics community in Canada is actually very close and collegial and supportive of one another, but that even if you
that does not sound like the polling industry at all, by the way.
It's true. I feel that way. The amount of congratulations that I received from peers really was incredibly touching. But there are all sorts of different types of economists, and we kind of get labeled with the same title because we have them. But just like there's all different types of doctors, and you wouldn't want like an ophthalmologist doing heart surgery on you, there are different types of economists. Not to compare an economist to a doctor who has real impact in the world and cannot be wrong. Economists probably believe they have more impact than they do and are often wrong. But when I worked for an asset manager, the role of the economist is to look for flaws in logic and risks and being able to see what are markets not pricing, what are the tail risks, and to lean into the alternative scenarios. Whereas the role at a large institution like RBC is to really help guide your clients down what is a reasonable base case. How do you form a path down the middle that allows us to make rational, straightforward decisions in a world of incredible uncertainty? So I have become more comfortable with thinking along the middle of the lines, even though it seems sometimes less eccentric to say this is a good base case. Most of us in our day-to-day lives, whether we're businesses or going to make large purchases, anything from a washing machine to a house to a car, really want to know what is the most reasonable base case. So I've been shedding off those tail risks a little bit more and trying to just help RBC and help my clients understand how do I help lead down this solid, defensible path.
It sounds more difficult because generally in my life, I've found that it is easier to observe what people should not do than to know for sure what they should do.
And it's about to get a whole lot harder, because we've talked a lot about the this time is different or things are new in the post-COVID economy. But I think what we're coming to recognize is for a while we felt like, oh, these years after COVID are just part of this distorted cycle and things are going to go back to normal or a new normal. And we'll be able to use the same tools and techniques and decision making functions that we used before COVID again. But in the past few years, it's become clear that those uncertainties and those challenges are actually getting larger, not smaller. And there's all manners of things we could talk about, but the data that we used for the last 50 years is just not as helpful as it used to be. The leads and lags on variables that used to tell us with pretty good conviction where we'd be 3 to 6 months from now aren't working. And increasingly, we're stuck with this, what are politics and what are policies? And what are the ultimate realities that come from those policies? Because sometimes those are different too. So the role of the economist has always been to look at information and then say, what is this going to mean for the future? But our information is increasingly unclear, and what it means for the future is increasingly unclear. So to start with, I think the step one is to recognize that and at least admit it, and that the powers of the economist, at least the traditional economist, may be lessening. And then step two is to think, all right, how do we approach this new economy and maybe keep our jobs?
What are the things that have happened that have broken your models?
Lots of things, and they vary a little bit by country. One of the really big ones in the United States, which has a phenomenal impact on a range of other areas, is actually the extent of government spending in a non-recessionary period. So, David, you might remember, I think you probably had to suffer through an Econ 101 class at some point in your
I
life. Most
I
of us
sure did. Yep.
Yeah, most of us did that. And so we were all generally taught Keynesian economics, which is governments are supposed to spend in bad times and make things less challenging in recessions. When people lose jobs, they expect some government support and then pull back in good times so that there's money left for a rainy day. But the US has actually is spending more outside of a recession than it ever has in its entire history.
It will never rain.
That it will never rain, and they are on track in the next couple of years to see their highest debt to GDP ratios ever. So this has actually produced a U.S. economy that has remained substantially stronger than the rest of the world. We have a AI tech boom that is changing a lot of the ways that U.S. economy is operating and not impacting other economies like Canada to the same extent coming through. And then we have a theme I feel very strongly is underappreciated. Some folks call this a K-shaped economy. So if you picture the letter K, you've got the upper part of the K where things are going well and the bottom part of the K where things are going poorly. You can use that term. You can use the term unevenness to describe. And what this is doing is we know that high income Canadians and Americans have benefited just disproportionately from stock markets that are doing really well and actually been beneficiaries of higher interest rates, this huge increase that we've seen in rates, whereas low income Americans and Canadians are not getting those benefits and are actually seeing larger individualized cost of living shocks. So food, gasoline, rent are disproportionately doing that. So why did that break our models? It's because there's two types of data that economists get. We generally call them hard data and soft data. Hard data is data that's actual dollars. So retail sales, how many dollars were spent in the whole economy? That's a hard data piece. That data has been so-called resilient. That's the word. It's so resilient. There's no recession here. What are you talking about? And soft data, which looks at things like confidence and is based on surveys, it gives everybody in the data the same weight. you and I and the gas station attendant and the small business owner and the CEO all take the same weight in that survey. They don't differentiate. That data has been extremely weak, looking like a recession. So, what's been fascinating is that the stock market and central banks are looking at the whole of the puzzle, and the whole of the puzzle looks great because high income folks are disproportionately spending and keeping the entire boat above, and low income are suffering disproportionately. And if you use models that look at confidence or the whole, everybody weighted equally, those tell you we're in a recession. If you look at the aggregate, those tell you we're doing just fine. We have never seen a break like this in these two types of data. What I find really interesting is that some folks have been very dismissive of the confidence data. They say things like, well, then it's just that they have the wrong expectations or they think things are worse than they are. What are they talking about? There's been wage growth. What are you complaining about? Hear these themes. But actually, wage growth for those groups has been much less than the higher groups. We know empirically that they're not doing as well. So, two things can be true at the same time. Your whole economy can look good on the surface, but large segments can be in really difficult shape. That breaks our economic models, which are used to relying on one part of that puzzle and not putting those two stories together.
So just explain this to me because I had my last guests, Kevin Carmichael and Amanda Lang, said a very similar thing to me, which is we need to stop relying on averages and start looking below the average at what is actually going on under there. I can't believe we didn't do that already. I mean, when I do polling, I get the top line of what does the whole country think, but the first thing I look at is, well, how does that differ by demographics and how does that differ by region and all those things? Economists must surely have always been looking at that.
No, some economists do. As we talked about earlier, there are different types of economists. You had Kevin Carmichael and Amanda Lang on. You also had, I think, Armin Yelnizyan, one of the most important economists in Canada, on. Her entire career is dedicated to the second step,
Right.
looking below the surface and really pushing on that string and helping to illuminate folks. So there are economists that do it. And yet, looking at the whole is not necessarily wrong. It just matters on your perspective. So I'll give you an example. The stock market doesn't really care in aggregate. The stock market doesn't really care in aggregate what's happening beneath the surface. They need to know what is the state of the whole pie. How much money is going into the pot matters to them. A central banker is in a particularly precarious situation because they are there to target inflation of the whole, 2% inflation. What drives total inflation in an economy is actually how much money is going into the pot in its totality. So they only have one policy rate to target the whole. They may be very aware of what's happening under the surface, but it's the whole. If you have a company that services all types of clients, you need to know the whole. If you, however, are a type of business that is focused on serving a client segment, maybe it's you serve the ultra high net worth, let's think a luxury brand, then you don't look at the whole, you look at high income. And there are other places that serve a lower income consumer that will look under the surface. So it's not that one is bad or good. It's that it depends on your perspective. But when you turn on the TV, David, and people say the GDP report came in and it was strong, no recession, my hope is that in 2025 that we say on the surface there is no recession, but there are challenges underneath. Now, I will put an asterisk on this. A lot of mainstream economics has been focused on GDP per capita. Have you heard this one?
I want
GDP
to.
per capita.
I have never. I until a year ago, I think, maybe a little bit longer. I had never heard this term in my life, and now it is the new metric that everybody's using to measure our economy, and people are upset about it.
People are upset. Okay, so there's a good reason you never heard about it until about 6 to 9 quarters ago. I'm going to put an estimate on when I think you probably first heard of it. And that's because it was largely irrelevant. The total pie was growing at the same pace, approximately, than each of ours part of that pie. And then, about 8 to 9 quarters ago, 2 years, look at me talking in quarters, about 2 years and 3 months ago, there began to see a divergence, and that divergence has accelerated. So GDP, gross domestic product, will tell you how big is the pie on the table, and GDP per capita will tell you what is your personal part of that slice. What slice are you getting and how big is it? For the last 6 quarters, over the last year and a half, your slice of pie has been getting smaller, at least in average, for each individual Canadian. And that's largely because we had such an exceptional population boom that we had approximately the same pie, but it had to feed, 2 million more people. So your share of it got a lot smaller. Going forward, I think GDP per capita is going to become even more interesting because we're going to see population in this country shrink for the next 3 years. So the pie is going to stay about the same, but there should, at least in theory, all of us should start getting a bigger piece. And we'll probably see the reverse, that after 6 quarters of GDP per capita shrinking, you might actually see it start to expand, whereas the whole pie doesn't look as good. Now, the reason people are upset about it, or some people push back against it, you actually see either ends of the spectrum pushing back. Some folks will say it's irrelevant if you're trying to look at inflation or you want to know how much stimulus to push through the economy, because what matters is the whole. That is true in so many circumstances. Now, there are other folks on the other end of the spectrum who might say, well, I don't like that because there are some folks who are actually getting a bigger slice of pie. Those are the high income, those who are benefiting from higher rates in the stock market on fire and who are homeowners. And there are others who are getting substantially less. So not only does GDP per capita not speak to the unevenness within it, but it's actually downplaying how problematic or difficult this economy has been for a certain segment. So I think what I am enthused by is that the mainstream is now doing that second step. Growth is looking like this, but what does it mean for the individual? We probably have to go a step further and say, okay, so GDP per capita is another measure, but I think one thing that'd be really good is for us to start thinking about the different types of consumers. What a horrible economics way to think about it, and saying, okay, how are renters doing? How are homeowners doing? How are low income? How are high income? That needs to be part of mainstream economics. And if we don't do that, David, I genuinely believe the profession is just going to lose some more credibility because people feel disconnected. If I get on TV and I say, Canada's not in a recession, everything's doing great, consumer confidence is down, but it shouldn't be. People will say to me, my friends, my family would say, you're not speaking to my reality, and therefore I don't believe your statistics or I don't believe your interpretation of it. The truth is in the data. Maybe you just need to expand the amount of data that we have in the mainstream. GDP per capita might not be perfect, but the idea that you recognize it and that some of your listeners might have heard it before is a step in the right direction.
Okay, let me just pull on this and parse it a little bit, because then I'm going to take what I know and add it to what you've just said and say these two sides of people who are doing well and people who are not doing well are not the same size of populations. Because when I ask people whether the country's going in the right direction or the wrong direction, less than a quarter, fewer than a quarter, will say the country's headed in the right direction. 75% say the country's headed in the wrong direction. If I ask whether the country's in a recession or growing, whether the economy's in a recession or growing, 5% will say it's growing strongly. Maybe 20% will say it's growing at all. Okay? So how small is this group of winners and how big is this group of losers?
Well, here's a way you can think about it, is that historically, this is US data, but you could probably assume it's similar in Canada, but the top 20% spend about 40% of the total amount in the economy. So the really sort of top 10 to 20 are the significant drivers of total growth in spending terms in an economy. And as long as that group is spending, you will probably see the economy be resilient. One of the things that worries me in Canada and the US for the economic outlook, we have a base case where things, stabilize. We've got rates coming down quite a bit this year. The US has a lot of fiscal stimulus, productivity coming through. It's not a horrible outlook, at least not on the surface. But if we saw something like a material stock market pullback, not our base case, let's just do the thought exercise, and that top group suddenly felt like they were experiencing a wealth shock, then you lose one of these large supports underlying your economy, and you'd start to see things start to decline. But again, it depends on your perspective. We can speak to what drives broad inflation, what drives spending in economy, but those statistics are not helping us make people's lives better or solve the cost of living crisis. You know, I think a lot about one of the things that we're thinking about is the individualized inflation basket. Because if you think back to 4 years ago, we hear a lot, and the Bank of Canada is cutting interest rates because inflation is solved, or this is what we're told, because inflation in year over year terms, what you bought this year compared to what you bought in December of 2023 is now up 2%. We've come a long way from the 8%. And so we are being told that inflation is back within target. Empirically true, Dave. That's true. That's not wrong. That's no one trying to trick us. But compared to where we were in 2020, prices are up 18%. Food prices are up 27% in 4 years.
Can I stop you for a second?
Yeah.
On hold, limbo, purgatory, betwixt and between, gray zone. Call this suspended state what you will, but none of them are a comfortable or, more important, productive place to be. I've been talking here about a recent federal cabinet order asking the CRTC to reconsider their interim decision that allows competitors like our presenting sponsor TELUS to access wholesale internet services and bring them to new customers in the Ontario and Quebec marketplace. There's a couple of really important knock-on effects to that, Herle Burly-ites. It's going to drastically limit consumer choice, as well as the benefits real competition brings to a market. And it threatens to discourage more investment and future infrastructure development in the sector. See, based on the CRTC's interim ruling, TELUS had already invested heavily in the region, innovating new product bundles and services, making economies of scale work the way economies of scale should work, and generating thousands of new customer signups. The cabinet order puts all of that, not only in the aforementioned limbo, but in jeopardy. I mean, why would a company want to continue to invest after such a flip-flop? Especially a facilities-based carrier like TELUS, who normally operates as major infrastructure builder and innovator in Canada. It's disincentive with a capital D for Canada's investment climate, and deprivation with a capital D for consumers, who lose the benefits fair competition brings and the right to choose their internet provider. TELUS may be sponsoring this message, Herle Burly-ites, but both of those issues reverberate way beyond them. If it's reverberating with you, please sign the change.org petition at demandmoreinternetchoice.ca.
So, Francis, I was really confused about the affordability matter because Jim Stanford, who, is a union economist, told me in the podcast a few weeks ago that wage gains had outstripped inflation costs over this period of time, and that in data terms, people were not worse off than they were before the inflationary period started. What do you think?
That is empirically true on the aggregate. If you look at the average inflation basket, CPI, it's up about 18%, and average wages for the whole group are up slightly more than that. But if you look below the surface, that's actually not uniformly true. And even if wage gains are up across every income group, that's still based on the consumer price basket looking the same for everybody. But let's just take a step back. If you look at middle income Canadians, their disposable income is up about 3% in real terms. So wages minus inflation are up about 3%. But high income consumers in Canada, high income households, their disposable income is up 13% in real wage terms. So 4 times as much. So even if it's true for the totality, that is an incredibly uneven dispersion of, well, wages are up, so what's everybody worried about? They're not worse off. But I also might take it a step further and say we don't all have the same baskets of goods that we're buying. So even when I use that calculation, it's not sufficient. What I need to do, and we're working on this at RBC, is to build price or consumer baskets of goods and services by income group, because we know that lower income Canadians spend more of their basket on things like food. Food is up 27% in 4 years. Rent is up 25% in 4 years. So the lower middle income CPI is likely higher than the high income CPI. So again, true in totality, but my guess is if you picked a random person off of the street, that wouldn't be true for their individual reality. And so we just have to be cautious about recognizing that these total stories or the average stories are not telling the stories underneath. But again, if you're the Bank of Canada, you can be aware of that, and this Bank of Canada is aware of that. We know that through some of their communications, but that's not their job. Their job is to look at inflation as the whole. I also think it's right to say, well, prices are up 20% in the last 4 years, to speak through the wage component, because inflation matters relative to wages. But it's too simplistic an argument to say, well, wage growth is up more than 18% over the 4 years. Moreover, the affordability crisis didn't just land in 2020. The housing affordability crisis harkens back. Sorry, my Quebec is showing.
Yep, harkens back.
Harkens back. Thank you for that. Back to 2014, and even before then. So even that simple 3 to 4 years comparison is just not telling the whole story. And when I say we sort of owe it to Canadians as economists to add that second layer, or even if we haven't yet done the work, to say, if you don't feel like this data represents your individual circumstance, it's probably not that the data is wrong, or that the general commentary around it is wrong. It's that it's the wrong data piece. It's the wrong part of the puzzle that we're showing to you. We're showing you a piece of the sky on a puzzle when really your experience is in the bottom left and it's a forest piece. So we're just going to have to start doing a lot better job in mainstream economics, just even highlighting that the experience is uneven. And I'm not a political scientist. I look at charts, but it doesn't surprise me that we see developments in the United States where that K-shape and unevenness is especially pronounced, leading to certain political outcomes, because their K-shape and unevenness is even more pronounced in many ways than what we see in the United States, what we see in Canada.
Right. And I find this to be a really important point, how far this goes back, because my view is that the recent inflationary period was the straw that broke the camel's back, not the cause of the problem itself. I mean, in 2015, it was an intellectual underpinning of the Trudeau campaign that the middle class had not had a raise in real income terms in 30 years, that real incomes for the middle class hadn't risen in 30 years. And probably nothing changed over the last 10 years. And then this happened. And all of a sudden, you have people who have full-time employment showing up at food banks because by Thursday they're out of food. This is a long-term pattern that has created political divergence, but it's a big economic story that nobody seems to have any answers to.
I think that's fair. And often we hear, what are the implications of protectionist policies that are coming through? Like the protectionist policy is the shock we have to apply to our model. But if you look back in the past 10 years, a lot of these developments, to me, things like protectionist politics or policies, are symptoms of the problem, not the problem themselves. In 2016, we saw Brexit. We have been watching the share of manufacturing in the United States decline for 40 years. We've seen productivity in Canada decline for 40 years, and it's now hitting base bottom levels. The last 4 years were accelerants on trends that we were already largely seeing just about everywhere. So I have an economist on my team, Michael Reed, in the United States, and he said to me, we were talking about our year ahead, what should be our themes for 2025? And I said, do we go with K-shaped economy again? We did it last year. Listen, there's some strategy around these outlooks, okay? You want to make sure you get some readership. And he said to me, I think we have to say we're going from lowercase k to uppercase K, and that these themes are going to continue and accelerate, that they didn't start in 2020, that they were just accelerated by 2020. That's generally why a lot of the models were actually struggling over that period as well. What's different now is that we added on one of the most aggressive, if not the most aggressive by other measures, increase in interest rates that many people had seen in their entire lifetimes. I mean, interest rates have been on a downtrend literally my entire life. Going back to the 1980s, as long as I've been alive, interest rates have been in a downtrend. And now we are starting to compound the protectionist policies, the risks to growth, the unevenness with this big interest rate shock. And sometimes I think to myself, we try to disaggregate the consumer into middle class. But really, the economic divide in Canada is between renters and homeowners. And one step further, renters and homeowners who got in before 2016. That is the economic divide that creates a substantially different economic outcome over the course of someone's effective entire life. When people say you have a 30-year mortgage, to me, what that says is if you had to pay double the value of that house compared to your neighbor who got in 5 years earlier than you will carry that economic difference for 30 years. Plus, you add interest on top of it. So I know I've talked about middle income here and lower income because that's a way that we can disaggregate the story, and Statistics Canada divides it that way. But my strong preference is to say this is a country of renters and homeowners. And until we can fix that problem, the other ones to me are very distant seconds.
Right. So it kind of feels to me, Frances, like the ordinary person is facing a bit of a pincer move against them, which is GDP per capita is in decline, which, unless I'm understanding that incorrectly, means our standard of living is in decline in aggregate terms. And that's one thing. And on the second thing is we've got these bizarre distributional effects whereby all income gains, all GDP gains that exist go to the upper income earners in the country.
Not all, but a majority, yes.
Right. So that's a pretty devastating 1-2 punch.
Yes, and I would add, isn't it even more insulting when you turn on the TV and you're told everything's just fine?
Right. Right.
So we have a lot of things that we could do better in this country, but I'm just an economist sitting behind a screen asking people to love us. The first and best thing we could do is start with acknowledging the unevenness that exists within these so-called gains that have come in the past 4 years. Because until we do that, I'm not sure we're going to be able to accurately diagnose the challenges that exist, and certainly not be able to fix them.
Okay. When you go back, you just mentioned at manufacturing. Mm-hmm. What are your thoughts about trade liberalization generally? I mean, one of the things that confuses me is, everybody now knows that the manufacturing in Canada and the United States was hollowed out by NAFTA. And a political candidate named Ross Perot told everybody that was going to happen at the time. But the counter narrative was, we're all going to be better off. We're all going to make more money. Everything's going to be more successful. But it did hollow out manufacturing. And I mean, how is it not possible? How is it possible that everybody didn't foresee that happening? Like, if somebody described NAFTA to you, wouldn't you just assume it would have the impact of driving manufacturing to Mexico?
Well, I wasn't in the rooms at the time, but there are some things that will always be true, and we talk a lot about the new economy and how things are changing, and how maybe central policy mandates are going to change, or there's unevenness, or AI. Some things will always be true, and there are some things that you learn in Econ 101 that we will still be teaching 100 years from now, which is, for the most part, people try to acquire things at the lowest cost available when the quality is relatively the same.
Right.
That is a truism that will probably exist forever. You might asterisk that and say that some people will make some qualitative choices around, for example, ESG concerns, or they'll feel better about a purchase and willing to ascribe a higher value to it. But in two sets of things are relatively equal, you will seek the cheaper of the two. So what's been really fascinating to watch is this thing that we were all taught. So we were taught that governments spend in bad times and pull back in good times. That was the first fundamental thing we were taught about economics. And the second thing we were taught is that free trade is good. And I think the example that's used all the time is there's two islands. There's one that only makes oranges and one that only makes bananas, and you build a bridge between them, and then each island gets to experience oranges and bananas. And this is good. This is how they teach the concept of free trade, right? And then everybody's better off. But that both those two fundamental economic principles that have been used to construct policy are now being turned on their head. And as we go forward, they're being challenged by very real changes. Like, we look at things like world average tariff rates. Those had been declining since the 1930s and started to climb in 2018. If you look at US average import duties, those were around 20% in 1931 and have fell to about 1% in 2009. Trump increased them to about 3% following his first tariffs. And if he applies 25% on all imports from Canada and Mexico and 35% on China, that number is going to quadruple to 12.5%. When you talk about what breaks models, it isn't just the data. When people behave and use these economic principles as we've always believed them to be true, that trade is usually free, that it goes in one direction, that governments spend in bad times and in good times, then everything works. But these types of new policies that are coming through break the way that we've considered constructing policy. And so whether or not it ends up being a 25% tariff or a 10% tariff, we know the direction that things are going to go in next. And for the tariff to be successful, it has to reach a point where the intended victim of the tariff is no longer the lowest cost producer. And that is a material global economic shock. The difference is in 2016, prices were over 30% lower, and Americans and Canadians had not just experienced the largest inflationary shock of most of their lives. So I'm curious to see how this next evolution in trade and thinking about trade is different, even just 8 short years later than it was 8 years prior. That's how I think about it, that the fundamentals of trade and how we've built out trade policies and how we've built out trade economic models are no longer the same. Is that fair?
Yep, it is.
So, some well-meaning folks at our sponsor CN thought it might be a good idea for me to sing a railroader version of the 12 Days of Christmas here on the pod. They even wrote one. Yeah, no. CN has never heard me sing. I did take a look at the lyrics they wrote up, though, and really not bad. Not that I'm going to sing them, although I would like to hear Corey and Scott do a duet, with Jordan singing harmonies, or maybe just Corey warbling solo. Anyway, the point of the CN version of the song is that just about everything you will deploy to celebrate this holiday season moved by train. The milk and cookies for Santa the kids leave out, moved by train at some point. The holiday ties and obnoxious sweaters, moved by train. Firewood, train. Christmas trees, ornaments, oh yeah. This year, CN will be moving more than 50,000 trees to Canadians who celebrate Christmas. 33,750 of them, give or take a few, will come directly from Nova Scotia. You might be interested in knowing that one CN shipping container can carry about 900 trees. And this might be more Fargo than Christmassy, but once those trees have gone through the wood chipper after the holiday season, CN will move the chips to factories where they'll become wood pulp. I'm tempted here to start singing "Oh Wood Pulp Tree," but I won't. Chestnuts? Check. Turkeys? Yep. Candles? You bet. Paper, ribbons, bows? CN anticipates moving 2,000 carloads of wrapping paper. Oh, and toys. Yes. Games and toys will have occupied more than 1,700 CN container cars this year. That's more than 17 two-mile-long trains. Look, I just like reading spots about the holidays. To use a variation on a really old slogan Scott will surely recognize, tune in for another one next week. Same Herle time, same Herle channel.
So while we're on the tariffs, let's just talk about it for a second. There seem to me to be two schools of thought, one of which is that this is Trump's threat of 25% tariffs is the beginning of a negotiation. And we either have to really pressure American economic interests to pile in on our side, or we've got to increase our defense spending, or we've got to secure the border. We've got to do something to negotiate with this man. Other people say negotiations are pointless because this is his economic policy and this is his revenue policy, that this is where he's going to fund the government from. And so you can't negotiate out of it. He needs these tariffs to happen. What's your analysis telling you about those two schools of thought?
Yeah. So we focus on what we know to be true. The first thing is that back in Trump 45, there were a lot of policies that we had to measure out that didn't turn out to come to fruition. So there were comments about the potential to increase tariffs on Mexico by 25%. Those were not ultimately imposed. There were 20 to 25% tariffs threatened on Canadian auto exports. You might remember that. So there was a lot of policies that were potentially thrown out there that didn't end up coming into action. So there's a delicate balance between having a sense of what those would mean to the economy versus writing an 8-page report on every potential outcome. And more problematically, a lot of these policies that could come through, their underlying components matter a lot. 25% blanket tariffs is one thing, but tariffs on certain sectors, but not others. Is there retaliation? The range of scenarios that we could create is so vast that the exact dollar implications for the Canadian economy are really difficult. So what do? The first thing that we realize is that I tend to think about tariffs as occurring in 4 steps. Their implications happen in 4 steps. The first thing we know to be true about tariffs is that they tend to create front loading. So what we witnessed with steel and aluminum tariffs, for example, is that if you thought that the price of, I don't know, your favorite chocolate bar, I don't know, David, if you have a favorite chocolate bar or a favorite, maybe a treat you like.
Crunchy. The crunchy.
Crunchies. Excellent
Big
choice.
sponge toffee fan. Yeah.
I'm a coffee crisp fan.
Oh, I like that too. Yeah.
That's a good choice. They definitely disappear from my son's Halloween baskets very quickly. So if I thought coffee crisp prices were going to go up 25% next month, I think we would all do the same thing. We would go out and buy as many as we could possibly store. So you could actually see a boost to the Canadian and U.S. economies in advance of these threatened tariffs that come through. So things start to look better. That's actually the first thing that we witness. The second thing we witness is what we call price level shock. So the price increases, and it increases one time. Just going back to the concept of how we calculate inflation in year over year terms. So that shock is very big, lasts about 12 months, and then becomes irrelevant to your year over year calculation. So we call it one time, but that's not to say it's not permanent. It's permanent. It just becomes largely irrelevant 12 months later. And remember, central banks are targeting the year over year. So they're not likely to respond to one-off shocks to prices. And they've been very clear about this. They write a ton of policy about it. Then comes the third step, which is a difficult one. It's the demand shock. So if my coffee crisp, I went out and first of all, I bought 3 years worth of coffee crisps. Yep. Then the price went up. What is my purchases of coffee crisp going to do for the next year? Just plummet, right? So it's two things. You've already front loaded a bunch of them. So you've got an inventory stock up and the price went up really significantly. And then you see a demand shock. And what we worry about for the United States, if they were to impose tariffs on Canada, is that third step, that the demand would just dry up really aggressively for our goods that we send to the US. Now there's sort of a fourth step, maybe, that's a question mark in my mind. But I'm going to add it in because maybe tariffs work. Well, maybe they work, and it creates reshoring in the country that puts forward the tariff. So if you think about the consumer, they saw prices go up permanently. Their economies get hit, especially if there's retaliatory. That's supposed to be okay because you bring more jobs and income back home. Yep. And that produces some offset. So people say to me, what is the impact of tariffs? My first question to them is, over what horizon? Because even tariffs that haven't been imposed yet are uncertainty shocks and front loading. You want to ask me what tariffs are going to do 12 months later? They're going to create inflation. What are they going to do 2 years later? They're going to create a hit to growth and jobs as a result. What are they doing 5 to 10 years later? Maybe they're increasing growth over that horizon. So it becomes, I think that's the best way I can simplify it. But we do throw out numbers. We have done some work that shows, okay, 25% tariff applied to everything. That's going to basically damage growth for 3 consecutive years. It drops all of our GDP forecasts, for example, that come through. It's very problematic. But the likelihood that it's exactly 25% across the board is very low, and what sectors it's applied to will disproportionately hurt different provinces. So I really struggle with how many of these scenarios do we put out. We think about them, we run them in the background, but I would prefer we focus on what do we know to be true, regardless of magnitude, what is the direction of risk moving forward, and just taking a really even-keeled base case approach, I think is probably the best way to go about this for now.
And is that what Finance Minister Freeland should do in the fall economic statement? Like, it must be very, very difficult for them to provide any kind of long-term forecast right now.
Very challenging. Well, you can correct me if I'm wrong, but they do rely on the private sector to give a good sense of what's happening in the forecast. But anybody who's in the forecasting business right now has to say, down the middle, this is what we expect based on what we know. We know that shifting immigration targets are going to lower growth forecasts relative to what we thought for the next 3 years. We know that interest rates are going to be declining. Probably, our forecast is down to 2%. Maybe it's 2.5%. We're not going to get too wedded to that. We know that lower interest rates will help support growth in the second half of 2025. We know businesses are kind of depressed, but feeling a little bit better, and same thing with households. We know the unemployment rate is rising.
But they can't make a bet right now. Like, a business can't make a bet right now.
No, uncertainty shock. So this is what you know to be true, and you factor it into your baseline. So most outlooks right now will say it's low growth, it's not great growth, it's not strong growth, but it's not recessionary. And then what they will say is our confidence in our base case is very low. So just a reminder, when you construct a base case forecast, you kind of assign probabilities to a whole range of outcomes. And maybe you do 3. So you have your base case, and then colloquially your bear case, which is your sad case, and then your bull case, which is your great case. So you could have 3, or you could have 5, or you could make 10. And then you say, this is the probability I assign to each one. sometimes you end up in a situation where your base case is actually less than 50%. It just happens to carry the highest probability of all the other ones. It could be your base case is only 40% probability that comes through. So what forecasters are doing right now is they're saying, this is a base case. We have to go off of something, David. We can't just say, I don't know, too hard. This is a reasonable base case. And then we acknowledge the range of outcomes. So if you're a business and you're a household, you can't, or a government, you can't just have an action. But this is not the time, in my opinion, which is not worth much, to be making big bets. And nobody's going to feel confident saying this is a big bet environment. The good news is we're probably going to have a lot more clarity in a year. And a year is not a long time necessarily.
Unless you are the existing government of Canada. In which case a year is a pretty critical year coming up. 2024 has been one hell of a year. With the complete red sweep in the U.S., the forecast says 2025 might be even more interesting. As Team Canada tries to navigate the new political leadership and protect our economy, all of us curious and curiouser Herle Burly-ites will be focused on the all-consuming and consequential issue of Canada-U.S. relations. As we all do that, our sponsor, Fidelity Investments Canada, wants to encourage everyone to spare their curiosity for their investments as well at the end of this year and in the beginning of next. Year-end financial statements will be on their way soon, and it's a good opportunity to review those statements in detail and ask or re-ask yourself some questions. What investments do I hold? Are they appropriate? And are my investments delivering the returns I need to meet my goals? There are lots of perspectives on investing and what constitutes success. Fidelity has been a leader in the field for nearly 80 years globally and 40 in Canada, and it believes this. When all is said and done, long-term, consistent investment performance after fees matters. So in addition to following the negotiations, the politics, and policies closely, check in on your investments and talk to your financial advisor for help, because you've heard it before. Investment performance matters.
So how do you make big bets when a tariff policy could be imposed that would fairly immediately throw your economy into recession? How do you make big bets when your immigration policy is going to lower growth, but it has logistical challenges attached to it, and you're not exactly sure how that's going to shake out? There are geopolitical conflicts globally that are impacting supply chains and therefore inflation that are coming through. And then you have a central bank who is independent and can make choices to bring rates down to 1.5% or keep them close to 3%. That monetary policy and the cost of borrowing is also very, very difficult. So this is certainly a difficult time to make plans, no matter which component of the Canadian economy you are. And I know that that's not comforting, but sometimes the ability to acknowledge what do you know to be true versus what do you not know is a very good place to start.
Right. But one thing we probably do know is that until this is clarified, there's going to be a real chill on business investment. Right?
Absolutely.
Absolutely.
We call it an uncertainty shock. And you can see that this isn't just a Canada story, David. Like the uncertainty index for small businesses in the United States is its highest in the history of the index. So business investment is frozen globally. The difference is business investment in Canada is both cyclically frozen and structurally frozen. This is the big challenge with Canada going through a variety of these shocks. The way I think about it is that I think economies have what I'll call like their economic immune system. So there are countries that are like the equivalent of the guy in Venice Beach who is drinking green juice and doing 800 pull-ups a day. That's America right now. They've got a huge AI productivity boom. The balance sheets are great. Confidence is skyrocketing. CEOs are very happy. Their underlying economy was very, very healthy. Canada is like a little bit more likes to binge watch reality TV and has maybe had ordered pizza a lot this week and forgotten to take its multivitamin. It has a very weak economic immune system. Productivity is very low. Business investment has serially disappointed. We don't have breadth and depth of various business activity. We have problems that are well illustrated. We don't have a particularly competitive tax system. We've got a heck of a ton of red tape. So when you think about someone who has a really strong immune system and then they go visit a kid in a daycare center, which is where I get all of my germs, the one that has the strong immune system is like, oh, I got a little sniffle, but it was okay. That's the American economy. And then if you have a very weak immune system like Canada does, and you get hit with a cyclical shock or you catch a virus, it can take you out. And Canada's problem right now is that it has this very weak economic immune system. Productivity is very low. Our potential to grow is very, very low. And it gets hit with a series of shocks. So when you get hit with a series of shocks and you don't have that backup and you don't have some structural strength underneath, it can really take you down. And that's how I think about the difference between the Canadian economy and the US one. So if I'm, a parent taking care of a child, I would say, well, first let's solve this cold. But once we get over this, you're going to the gym and you're taking your vitamins. So one thing at a time. Let's get through, we've got interest rates coming down, which is very good. We got to get through potential trade negotiations. I think those are more urgent, but my goodness, these issues about how do we strengthen the economy on the 10-year and build up this so-called economic immune system, it's going to be really paramount. And we're going to be talking about it for the next 10 years, probably.
Okay. You said so much there. There's a few strands I want to pull at.
Okay.
The first one is this. You've referenced Keynes a couple of times. And there is angst in the land, not in the general public, but among some observers, about the fact that the finance minister may miss her fiscal guardrails in the fall economic statement. But is this a good economy, in which case the government should be pulling back, or is this a bad economy that the government should be stepping forward?
I don't transact in shoulds because that's not my role. My role is to say, what are the implications of this? And I think that fiscal policy is absolutely better suited towards targeting unevenness within an economy. But the problem is there's going to be pressure on governments globally. So it's not just a Canadian problem to support areas of weakness versus broad-based support. Because broad-based support, remember how we talked about the difference, the whole pie, the money in the pot is actually very strong. So if you add more into the aggregate, you will increase prices for everybody. Adding more to the aggregate disproportionately helps higher income and then disproportionately hurts those who are exposed to inflationary pressures, which is more lower and middle income. But if you can target and support certain areas of the economy more, then this is the only type of policy that actually can have different policies for different areas of the economy. So that I think is really critical. But I'll go to my grave on this one. I still think that it will always be what a dollar of government spending is spent on at any level of government in any country across the world over the total amount that is spent that has impact for Canadians and for things like growth and inflation. For example, I think I used this example with you maybe a year ago, but it's a powerful one. Supply side spending can boost growth and lower inflation. If we had $100 for every Canadian and we used it to somehow, it's an easy thing to say and a hard thing to do, build more homes, we would see home prices decline. If we took that same $100 and gave it in an envelope to every Canadian and said, put this towards buying a house, you would have home prices rise. If you said a government has broken fiscal guardrails, doesn't matter which one, and they're actually building out sewage and water developments and infrastructure so that we can expand some of the infrastructure that's missing to build out more housing developments, the bond market would celebrate you. It could be ultimately deflationary. It could support productivity. And I don't think you'd have a lot of economists saying that's a problem. If you, for example, used it on demand side measures and sent out debit cards with money on them, that would probably not help Canada's economic immune system, and it would increase inflation. So I just take issue with, there are reasons why it's important to stay to the fiscal guardrails. We know credit agents watch these. We know that we have to maintain fiscal responsibility. And even though on a federal level, Canada actually looks really good relative to its partner in the US, we have to maintain a place of fiscal strength so that we continue to have this beneficial access to the bond market. It's not that that's unimportant, but if you're asking me as an economist, how does $1 billion impact my growth forecast or inflation forecast? I will never be able to tell you that answer unless you tell me what it's being spent on.
Okay. So here's a little bit of an out of the blue question. You may not get this one all the time. What would be the impact on the Canadian economy if you added 2 points to the GST, added 2 points to the GST and started investing $20 billion a year in Arctic defense?
Arctic defense is actually something that I hear a lot about lately, believe it or not. We haven't done that analysis, so I don't want to extrapolate too much, but we do have some examples of what defense spending does do. And it does tend to be supportive of growth because it's infrastructure development. It does tend to create jobs. But there's all sorts of
The commies at the University of Regina always used to tell me that it had the lowest multiplier of any government spending.
That may be true, and it's something that we should probably think a lot about because it's a topic that's coming up more and more. And then there's some other multipliers. This is why economics is not just something, that's why economists often work through lunch. How do policies like that, for example, strengthen our relationships with our geopolitical allies? Does it impact trade negotiations? Is it actually used as a tool when making trade decisions? That's an element that can flow through into the story. Like I said, we should be doing more work in this area because I hear the topic being raised more and more, and it's certainly an important one. But I could pretty much off the top of my head say that spending on things like infrastructure of any kind will always carry a higher multiplier than just cash infusions.
Right. I'm curious about where the money should come from on this defense thing, because there seems to be a consensus among all the smart people that we've got to hit this 2%, if not 3% target, right? But 2% is $20 billion a year, right? Additional cash. And everybody seems to think we should hit it. And everybody seems to think the place to spend it is in the Arctic, that's our job to defend the North. Okay, so there's a consensus on those things. We're just missing the consensus on the small matter of where to find that $20 to $30 billion. And to me, the notion of pulling it out of consumption is going to be very unpopular. Like if you were to pull $20 billion out of existing government spending and reallocate it to defense, there'd be a lot of dogs howling out there in the night.
Okay, so here's how I think about this. I'm going to be agnostic on the policy that you're thinking through because I'm not an expert on it. But generally how I think about it is there's 3 ways to get access to, let's say you had a requirement to spend $20 billion on something and it was a non-negotiable. What's your framework for thinking about where that comes from? So I'm gonna step away from your specific example to how would I think through that problem? Like we're in a job interview and you're like, think through this problem on the spot. This is how I think about it. So the first thing is to reduce $20 billion of spending from somewhere else. That can be growth negative, or you can put together the what is the Elon Musk department?
Doge, something.
Doge. So you could look for inefficiencies, for example, and come at it that way. So you could pull back on existing spending. You could raise revenues through a different source. All sorts of ways to raise revenues. I'm not a tax economist specialist. You could raise GST, as you said, or you could look for ways to, here's an idea, boost growth so that you could actually see more businesses spending and get more revenue coming in that way. Or you could be like America and impose some tariffs and get some tariff revenue. You're going to find revenue from somewhere. Or, so, it's not in like a household, even though household finances and government. So you pull back in one area, so you don't go to the restaurant as much. You find a new revenue source, you drive Uber Eats. Or the third one is to borrow. And to borrow, we go to global bond markets and we ask them to lend to us. And one of the really interesting things about financing in this way is that global bond markets tend to really pick on the weakest of the herd. And Canada is actually not the weakest of the herd right now. If you look at us relative to other options that global investors would invest in, the federal finances look stronger by many measures than a lot of the peers and competitions for that global bond market funding. The other interesting thing about global bond market funding is that these market participants think, traders sitting in Paris or thinking, oh, we'll go here and there, are thinking about what is the likelihood that you'll pay them back and how does this investment support Canada and build revenues going forward. So one of the things that I was very vocal about several years ago was that affordable and accessible childcare would be something you could fund and the bond market would not blink because they know the empirical studies that this improves growth over time and generally can be revenue neutral or revenue positive. So when you ask me, where do you find $20 billion? Those are the three sources. But I think sometimes we forget about that third pillar and how it is available to Canada. You don't want to abuse it because credit rating agencies will come for you. And, if a credit rating agency comes for you, that can be problematic. And you don't want to lose confidence from your bond market. But those are the three ways that you go about that. So it's not as simple as just saying you got to pull money from somewhere else. There's a lot of different ways that you can access that. I, however, do not work for finance. I never have worked for finance. And I realize it's more complicated, but hopefully that gives you a sort of framework about how you might think through that problem.
Right. Do you have a sense, though, of which of those would be least damaging to the economy?
Well, no, I can't say that, David, because the issue is it depends how you're doing. I mean, I would say that the best way to find money for Canada is to focus on building out new growth that raises revenue. That's always going to be the preference. If you can get businesses to spend and you've got more people with jobs, every time that you improve job, if someone gets a job,
but we don't know it. We don't know how to do this. If you've got a productivity bullet, give it to me right now. I've talked to so many business people, economists, policy people. What do you do about Canada's productivity? I don't, there's some obvious things people say we should get rid of our internal trade barriers, etc. But generally, in a policy sense, people don't know.
Yeah, stop asking economists how to fix productivity, because we actually know that there's a productivity crisis and we tend to speak to the macro. Okay, so we can see in the numbers how severe the productivity crisis is. You can see that. And we know that there are some things that are true across the entire country. We know red tape is problematic. We know we rank poorly on things like tax rates. We know interprovincial trade barriers are a problem. We know we don't take enough risk. We know that the housing sector has pulled too much money away. We know that there's a little bit of crowding out from the public sector. Everybody knows this. You've probably heard this 400 times on this podcast alone. But my limited experience with this, I say that with humility, is that when I actually talk to individuals across this country, small business owners and sector experts, what I hear is that the productivity crisis, while there are things that are uniform across the whole country, are actually vastly different sector by sector. So we're trying to give like a Tylenol to someone who has the flu, someone who has arthritis, someone who fell and skinned their knee, when everybody sort of has a slightly different problem that are, these things are body symptomatic. So housing, has lack of infrastructure challenges and significant need to build that out, a massive supply issue. The resource sector has been becoming a much smaller part of the economy, but hasn't caught on or been able to offset with renewables to the same extent. So I think I see there's a lot of value in our economic work in being able to say, here are the productivity, but assigning these macro solutions are both, massively, it's like boiling the ocean to do that. I think we have to start sector by sector. The productivity crisis took us 40 years to get into, and it's really severe. I was just talking to my team today. Have you heard the concept of economic potential? So it's not unlike personal potential.
I miss potential.
Yeah. So
Potential was the greatest. Potential was the greatest. I remember potential.
Yeah. So like potential, I'm reminded when I was a kid, I got like a C- in my math test, and my mom took away my TV privileges for the week. And then the next week, my brother got a C- in math, and we all went to Pizza Hut to celebrate. And I was kind of like, felt this was very unfair. And I remember my mother say, I have different estimates of your potential, which was fair, although he's doing very well. I have a lot of love for my brother. But we also measure the potential of an economy to grow. And there's two main things that go into it. One is your population growth. The other is your productivity level. Or the example I've used a lot, and I have a very poorly viewed TED Talk on this. I don't know why I thought this would be a good TED Talk topic. It seemed like it was COVID. It felt like a good idea at the time. But think about an economy like McDonald's, and the growth of the McDonald's is the number of hamburgers it produces. The number of hamburgers that a McDonald's produces is always a function of two things. How many people do you have working behind the counter? And how fast does every person make a hamburger? That's it. Every economic data point that you look at boils down into how many people do we have working behind the counter and how fast does every single person make a cheeseburger. That's it. It's productivity and labor force. If you look at our potential to make our metaphorical hamburgers, we used to run potential growth rates around 6% in the 1960s, and it's been declining ever since. We're running estimations or forecasts for what Canadian potential is by 2027. And our calculation is a Canadian potential in 2027 is 0.6% growth. To give you some context, that is the lowest potential growth in the history of Canada.
Right.
In an entire country's history. Now, this didn't happen in the last 4 years or the last 8 years. This has been happening since 1960. And yet everywhere I go, people say, give me your bullet point on how to fix a problem that has existed and persisted for 40 years. The first thing that we can do, that I try to do for my clients, is say, this is your new reality. Your new reality is a much weaker Canadian dollar. Your new reality is lower interest rates, but slightly higher, and potential growth of 0.6%. That would have been something that we considered like almost a recessionary type of environment before. And it's not going to get fixed in the next 4 years or 8 years. It's going to take at least 10 years to get there. And what my hope is that we start with, if you've ever been like, oh my gosh, my house is so messy, every room is horrible, they tell you start with one corner. I don't even care what corner it is, but choose a corner of this country and fix productivity sector by sector and region by region. And don't ask a macroeconomist to tell you how to fix productivity in like northern Alberta with the resource sector. We can be very helpful along a range of issues. I can help tell you what potential GDP will be in 2027, but this is a mammoth project to help get Canada back to the potential it deserves. And it's not going to be a bullet point. It is a major undertaking, and we need Canadians who understand their small corner store all the way to are running large operations to be vocal about what they need sector by sector.
I'm curious as to whether the need to reduce GHG emissions is still driving private sector decision making, or whether it's as passe in the investment world as it is among the rank and file population now to care about climate change. I had at one point understood that there was a massive shift in investment patterns based on finding low carbon investments to make, and that if you were low carbon, you had an advantage over high carbon in terms of attracting investment. Is all that still true? What I'm trying to really understand is anything still going on about climate change, or has everybody just down tools on this thing?
So there certainly is a significant emphasis on what is called ESG investing. And we know that there will be trends towards responsible investing that are going nowhere. There's also a really sizable shift in global wealth towards women. So there will be huge inflows towards women owning much more wealth than they ever had. And we know that women have different investment preferences and interests and tend to gear more towards this. But at the same time, my observation is that there are a lot of factors weighing on investment decisions right now that have maybe moved slightly above the list. When rates are really great and the employment market is doing well and you're not having trouble finding anyone and your cost of goods is low, these issues can take priority and emphasis. When you're struggling with sort of more of these urgent issues, I think you really try to pay attention to those. So I'll bring it back to this concept of getting hit with a virus and the state of your economic immune system. How we have an economy that continues to attract investment, we know it does. We know things like green bonds carry premiums that are actually well looked towards. We know that companies that can offer this type of investment will get more attraction. That's part of Canada's economic immune system. We cannot forget that is one of the things that works well for us on the immune system front. But when it comes to what are the viruses that have to be prioritized right now before we can get back to that, I think we're really focusing on tariffs, geopolitical developments, those interest rates coming down, the labor market, and how we're going to absorb and deal with shifting population flows.
Awesome. Okay. Thank you. Listen, it's been so fun to talk to you. I genuinely appreciate it.
It is a pleasure to be on the show, and I thank you for having me.
All right. Listen, everybody, there's your Christmas treat. Frances, have a great holiday.
Thank you. To you as well.
Right. I want to thank our presenting sponsor, TELUS, our sponsors, CN and Fidelity Investments Canada, and I really want to thank all you Herle Burly-ites who watch this show week in and week out or listen to it. Take care of yourselves, and we'll see you, I think, in my case, next week. But we're getting close to Christmas anyway. We'll see you. Take care.